What's considered a good mortgage rate in the U.S.? In the current market, a 6% mortgage rate is generally considered good for most borrowers, given the prevailing rates in the 6% to 7% range. When it comes to determining what constitutes a good mortgage rate in the United States, it's crucial to consider the current economic landscape. As of now, mortgage rates are fluctuating in the 6% to 7% range. In this context, a 6% mortgage rate is generally considered favorable for most borrowers. It's important to note that what's considered a good rate can vary, depending on individual financial circumstances, prevailing economic conditions, and the borrower's long-term financial goals. Several factors influence mortgage rates, including the overall health of the economy, inflation rates, and decisions made by the Federal Reserve. In a higher interest rate environment, a 6% mortgage rate is often seen as competitive, providing borrowers with reasonable financing terms. However, it's advisable for individuals to assess their unique financial situations and consult with mortgage professionals to determine the most suitable rate for their specific needs. What is the highest mortgage rate ever in the U.S.? The highest mortgage rate ever recorded in the U.S. was 18.63% in October 1981, according to Freddie Mac data. For those curious about the historical peaks of mortgage rates in the United States, the highest ever recorded was a staggering 18.63%. This pinnacle occurred in October 1981, marking a challenging period for homebuyers and the real estate market as a whole. During this time, interest rates reached unprecedented levels, significantly impacting the affordability of homeownership. It's crucial to understand that the peak in 1981 was an anomaly, and since then, mortgage rates have generally trended downward. While rates have fluctuated over the years, they have remained considerably lower than the historical high. This historical perspective serves as a reminder of the importance of monitoring economic conditions and adapting to the dynamic nature of the mortgage market. Will mortgage rates ever go back down to 3? Economists predict that mortgage rates could begin to fall in 2024. But a substantial drop may not occur until the second half of the year due to Federal Reserve decisions. The prospect of mortgage rates dropping to 3% is a topic of interest for many potential homebuyers and existing homeowners looking to refinance. While economists are optimistic about a potential decline in rates, the timeline for this shift is crucial. Predictions suggest that rates could start to decrease in 2024, but a substantial drop may not occur until the second half of the year. This projection is contingent on various economic factors and the decisions made by the Federal Reserve. It's important for individuals to stay informed about economic indicators and central bank policies that can influence mortgage rates. Additionally, those considering a home purchase or refinance should keep an eye on market trends and be prepared to act when favorable conditions arise. While the timing of rate changes is challenging to predict with certainty, staying informed and being proactive can position borrowers to take advantage of potential rate decreases. Is it better to buy a house when interest rates are high? Buying a home when interest rates are high may result in less buyer competition and potential downward pressure on sales prices. Refinancing options are available when rates decrease. The decision to buy a home when interest rates are high is a nuanced consideration that depends on various factors. In such a market, there is likely to be less buyer competition, presenting an opportunity for those looking to purchase a home. Additionally, higher interest rates can contribute to downward pressure on sales prices, potentially leading to more favorable negotiations for buyers. It's important to note that while high interest rates may offer advantages in terms of reduced competition and potential price negotiation, buyers should carefully evaluate their own financial circumstances. Affordability and the ability to secure financing at manageable terms are crucial considerations. Moreover, individuals purchasing a home during a high interest rate period should be mindful of the option to refinance when rates eventually decrease, provided that their financial health, including income and credit score, remains strong.